us today. My name is Miriam Wall. I'm an Executive Director here at Waystone. We're here to talk today about generating operational alpha, how to leverage fractional resources and outsourcing for alternative investment funds. Today's alternative fund landscape demands more than just investment acumen. It requires strategic operational excellence. Today, we're going to explore how funds across the spectrum, from $50 million emerging managers to multi-million-dollar platforms, are using fractional expertise and strategic outsourcing to transform infrastructure from a compliance necessity into a competitive advantage. Firms are staying agile while meeting and exceeding institutional standards. I am delighted today to be joined by Kurt Kim, who is the Chief Operating Officer of Aruta and previously served as a partner and COO and CFO of Promethean Asset Management. Kurt is also the co-author of the forthcoming book, The Alternative Fund Lifecycle, which provides best practices for launching, operating, and winding down alternative funds. Next up, we have Eric Konigsberg. Eric is the former Chief Operating Officer at Rockefeller Asset Management. He also serves as an Aruta advisor, working directly with Aruta's clients to scale operations, strengthen governance, and institutionalize best practices. And last, but certainly not least, my colleague Tyler Denon from Waystone. Tyler is the head of private fund accounting at Waystone Administration Solutions. Tyler has 20 years of experience in the alternatives market and has been dedicated to serving a diverse client base across private equity, real estate, hedge, and private credit. All right, so first, let me quickly frame our discussion with who we are and what we're trying to solve for today. So I'll start with Waystone. Waystone is a global provider of specialist services to the asset management industry. We partner with institutional investors, investment funds, and asset managers to build, support, and protect investment structures and strategies worldwide. Waystone delivers institutional-grade fund administration, compliance, and governance solutions to help strengthen operational integrity and solve investor confidence. Next up, we have Aruta. Aruta partners with alternative investment firms to attract top talent, build high-performing teams, and deploy fractional executives and domain experts across 18 disciplines. Aruta helps clients to align human capital with strategy to drive institutional excellence. All right, so what's on the agenda today? Before we set the broader market context, I want to anchor our discussion with a common definition of operational alpha. Operational alpha can mean different things to different people, so I'm going to ask each of our panelists to give us their own definition.
Thanks, Miriam. At Waystone, we perceive operational alpha as transforming back office precision into front office power. Our value as a provider lies not only in helping managers avoid misstatements, but in building processes which allow investment teams to stay focused. Whether they're sourcing deals, raising capital, or driving returns, our team of experts handle the execution behind the scenes. Through a strategic partnership with firms like ours, you get access to tailored services like fund accounting, investor services, and compliance, enabling the use of automated workflows for improved accuracy, access to real-time reporting platforms, allowing transparency to both managers and investors, and help securing regulatory alignment across multiple jurisdictions with our global compliance and governance solutions. In an industry where outsourcing is often met with skepticism, today, through real-world examples, we will show you when used tactically, it becomes a powerful and underutilized lever for performance and scale.
Exactly. I mean, I think of operational alpha as the compounding effect of a scalable infrastructure. So the idea is that the systems and processes that firms develop make the right things happen by default. So in other words, great operations doesn't just prevent errors, they're also able to create capacity for growth and consistency. What this means in practice, it shows up as fewer breaks, quicker launches, cleaner handoffs, and allows for internal resources to focus their time on their priorities. Firms that can do this well are able to use the same headcount and work within the same timeframes as other firms, but get better outcomes. It's steady, repeatable discipline, the kind that stacks up every day because the data connects, owners are clear, the checklists are simple, and the evidence is easily accessible.
Okay, super. Kurt, finally, last but certainly not least, can you give us your thoughts as well, please?
Sure. For me, operational alpha is about synchronizing operations across a fund's life cycle. So we're talking about the right strategy with the right resources at the right time. So when those three things line up, you create what all managers seek, right? Credibility, efficiency, scalability. But when they're out of sync, you've got major issues. You over-engineer, you're going to burn capital. You under-prepare, you're going to miss allocations. However, when you do get it right, everything accelerates. That's when you're truly generating operational alpha.
All right, so three perspectives, and I think one truth in there: operations can drive performance. So Eric, I'm going to switch gears to you. I'd like you to talk us through how Tyler's front office advantage can then manifest in practice.
Yeah, sure. I think the front office feels operational alpha when everything just works. So it's not just the tech or processes in isolation, but it's really when the data, the systems, and the people are all on the same page. So the day starts on time and without any issues. More specifically, it's when portfolio managers log in and snapshots match everywhere. So cash, positions, and exposures all tie. It's when traders see fresh cash right away and can execute without waiting for a spreadsheet. It's also when PMs open research and have it already linked to a live portfolio, so they don't spend time validating numbers and go straight to the ideas. It's when markets move and everyone is looking at the same information, so time goes to decisions, not the cleanup. It's also when, before a client meeting, performance and exposures already match the system. So prep is about the client, not reconciliation. And it's when the questions that used to take an hour now take minutes because the same information flows through every view. This clarity ends up changing behavior. There's less fixing, more deciding, cleaner meetings, faster turns, and fewer surprises. So when firms can do this across teams, that is when it turns into an operating edge.
All right. And so, Tyler, as head of fund accounting within a global fund administration firm, you must see this with your clients all the time, right?
Yeah, quite frequently, actually. One manager in particular comes to mind. They came to us about 2 years ago. They felt stuck. Their NAVs were consistently landing around day 60, which was putting a lot of pressure on their finance team. It was risking their LPA timelines and disrupting their internal monthly closing. The delays were creating a ripple effect across their operation, and to meet the requirements of a large investor's side letter, they had to produce a 45-day estimate. So essentially doing 2 runs of the entire package because they couldn't get their operations squared away. We stepped in with a few key changes. We introduced a daily processing model, set up weekly operational touch-base calls, and built bespoke workflows tailored to their internal needs. Our first win was turning that 45-day estimate into a reliable 45-day final, which cut down the timeline and eliminated the need for duplicate work. Then we layered in our Vantage portal, using its integrated approval workflows and secure file exchange to support fund level estimates by day 10, which align with their monthly close. But we didn't stop there. We kept optimizing, and now we're able to produce NAVs as early as day 3, complete with investor allocations and hypothetical carry models. What makes this possible wasn't just the technology. It was a dedicated group of team members who operate as an extension of our client's own team. And that alignment and responsiveness made all the difference. The result, a faster, smoother close process and increased confidence from both the manager and their investors.
Thanks, Tyler. Would totally agree. And Kurt, I think we spoke about this during our prep sessions. Leveling up your operations and reducing timelines like this can send a message to not just your investors, but also to the market, right?
Absolutely. So, I mean, what Tyler described on infrastructure and what Eric outlined on execution, both tie directly to your capital raising story. So for an emerging manager who delivers institutional grade NAVs from day 1, that's not just buttoned up. I mean, that's signaling credibility to allocators right out of the gate. Now, when a scaling fund brings in fractional CFO or COO expertise, for example, it's not about plugging holes. Obviously that's being done, but more importantly, it's actually about building leadership muscle, right? And operational discipline that also tells allocators, hey, not only are we looking to scale fast, but we're looking to scale smart. So the real question isn't whether to invest in operations. Obviously, it's where and when to pull the levers that will amplify your story through every stage of your fund's life cycle.
All right, that makes a ton of sense. Thank you, Kurt. Okay, so now we're going to move to the market evolution and some of the strategic imperatives. Kurt, I'm going to stay with you for this one. Can you help us to paint the landscape? So why are sophisticated managers now rethinking their operational models?
Sure. There are three converging forces that are reshaping how sophisticated managers build their operating models or modify their operating models. None of these should be a surprise to any of you. Allocator sophistication, regulatory complexity, technology acceleration, right? So allocators are now treating operational resilience as a direct proxy for investment discipline, right? So operational due diligence has evolved from a simple, straightforward compliance checklist to full-scale forensics. Institutional LPs are now running 18-month lookbacks and stress testing control frameworks. The regulators are demanding multi-jurisdictional compliance, right? I mean, it's now the price of entry. It's not a differentiator. Whether it's AIFMD in Europe, FinCEN rules in the US, MAS standards in Singapore, basically your regulatory infrastructure determines which markets you can access and frankly, which allocators will even take your call. So, and from a technology perspective, I mean, everyone knows about AI, automation, cybersecurity. These have become the new baseline for institutional readiness. So the allocators are expecting to see them built into your DDQs and reflected in your tech roadmap. So how are the leading managers responding to these converging forces? I mean, they're basically re-engineering fixed cost structures into flexible, scalable models. So variable cost architectures that flex with AUM growth, logical, on-demand expertise to eliminate overhead for what are episodic needs. You don't want to add overhead prematurely. Strategic partnerships that deliver institutional infrastructure, without institutional cost. So this isn't about fractional expertise or outsourcing for just efficiency. It's strategic resource allocation for advantage. And that shift toward flexibility and control, it's where execution discipline actually becomes the differentiator.
Thanks, Kurt. I wondered how far we'd get into this webinar without mentioning AI, so I'm glad you got the nod in there. Eric, I'm going to switch to you for the next section, just given your expertise and you've been on one side of the table going through allocator due diligence over the years. I'd love your perspective on how you see allocators responding to this higher bar in diligence today.
Yeah, sure. I mean, I think Kurt is absolutely right about allocator sophistication. And the bar isn't just higher, it's become clearer. So, investors these days have seen a lot of operating models and they know what good processes look like. And they could really tell within the first 5 minutes if you have the right setup in place. So what they react best to is a consistent control story. They want to see the same data everywhere, the same approvals every time, and evidence that is easily accessible. If onboarding, cash controls, and data checks all say the same story across the client experience, the books and records, and the performance deck, you get credit immediately. So where firms tend to get in trouble, though, is when each function has its own version of information. Investor relations has one, ops has another, finance has a third, and everyone can explain it, but nobody can show it in one view. That's when allocators start asking follow-ups and the meetings can start to go sideways. So the way to address this is not necessarily by creating more documentation. It's really about lining up the data and the views. There should be one golden source of data with named owners for the key controls, a weekly cadence to keep certifications current, and a centralized place to pull document support without making it a special project. When firms have all of this together, the diligence meetings will stop feeling like an exam and we begin to feel more like a confirmation that what you're doing is right.
All right, thank you, Eric. And Tyler, I know that you see this very frequently with your clients. You're in the hot seat very frequently during these allocator due diligence sessions. I'd like you to give us your perspective as well, please.
Sure. I mean, I think Kurt and Eric nailed it. Today's investor sophistication demands a lot throughout the relationship with a manager. And I mean, we can take a look at a simple interaction at the onset of a relationship with an investor. You're really excited. You landed a big ticket, you feel validated in your strategy, and it's time for the docs to start rolling in. But then the investor fills out, the subscription doc as a Cayman unit trust. And when they send it in for submission, they ask for your SOC 1 report, your cyber policy, your business continuity plan. And if you're the GP wearing a bunch of hats, IR compliance, or you're running a very small team of, specialized individuals, maybe people are scratching their heads. And if you're unsure on any of these fronts, it doesn't just slow things down, it shakes investor confidence. It's not the tone you want to set at the start of a relationship, but by partnering with firms like Waystone and Aruta, you're aligning your operations with a trusted name that's recognized by investors worldwide. That alignment builds a competitive advantage and helps you attract more capital, meet regulatory expectations, and grow responsibly with confidence. To solve for the problems I mentioned, you can use Waystone as an appointed AML compliance officer or an MLRO for Cayman, and we can easily share our control reports to satisfy DDQ requests at the click of a button. Leveraging independent oversight and regulatory compliance from a global perspective without increasing your headcount sends that clear message Kurt was talking about to investors. We're not messing around. The result is a stumble-free, transparent, timely data with frameworks which are regularly tested by third parties. When an LP asks for something, you're not scrambling, you're ready.
Thanks, Tyler. And Eric, I think both you and Tyler referenced this during our prep sessions, right? You talked in particular about the importance of both repeatable and consistent processes. Can you just take a minute to talk us through some of these processes, please?
Yeah, sure. I mean, and as you said, I think the key is to make things repeatable. So the idea so firms can really focus on making a control story simple and consistent. The goal is that, really anyone in the firm, from whether it be investor relations or the COO, can explain how investor onboarding, cash controls, and data checks work, on a day-to-day basis. And so when everyone on the team can easily and consistently explain the process, the meetings feel confident rather than defensive. One of the things that I suggest firms can do is, they can run tabletop exercises that test the workflow the way an allocator would. So before diligence, they can trace the recent subscription end to end, look at the AML review, the source of funds, approvals, systems onboarding, and record keeping, really to show where the process works, where the evidence lives, and to tighten any handoffs before investors ask. LPs today don't just want returns. They want a clean AML process, timely transparency, and a control framework that'll stand up to an audit. So really, you should have checks baked into the weekly routine. Review ownership logs, create exception reports, and keep certifications current without special projects. So the evidence is always ready, not recreated at the last minute and when under pressure. When that discipline exists and everyone can easily communicate it, firms will not have to stress about the scrutiny. The numbers line up, and the documentation will tell the story.
All right, thank you, Eric. So what we've seen from all three of you here is that there is a fundamental shift from reactive compliance to proactive positioning here. This is really driving home the idea that operational alpha drives performance. Firms are now operating globally. They're managing multiple regulatory expectations across both the firm and their product level. They're fielding increasingly sophisticated due diligence requests from allocators and institutional investors, and trying to keep up with that pace is no mean feat. So next, I'd like to dive deeper into some of the implementation challenges. I'd like to talk through these challenges that some firms are facing along this transformation journey. So Eric, I'm going to stick with you on this one, given your experience as a COO. Can you walk us through the transformation journey and typically where managers can struggle on that journey?
Yeah, sure. I tend to see three persistent pain points that consistently show up. And these relate to what I'll call data fragmentation, process debt, and talent gaps. So with respect to data fragmentation, when there are issues during implementation, the first thing firms tend to feel is drift. And what I mean by that is, the same position shows up three different ways across different systems, and every team ends up having a different version of the numbers. So at the same time, reconciliations also balloon and meetings become, trying to figure out whose number is correct. The solution is fairly straightforward. So the idea is really pick a golden data set, map that data once, and let everything else read from that. So, and in addition, while doing all this and changes need to happen faster, this is where you can bring in the fractional data system specialist and where they can help line up sources, clean up the mappings, and set naming rules so that the firm owns a single clean source going forward. When all these things are in place, ops risk and client reporting will tell the same story. The other another issue I see is related to process debt, and the really the big headwind there is drag. So workflows that worked at $100 million firm tend to stall at $1 billion firm. So the email approvals pile up, hand key mapping start to falter, and small operational breaks will end up aging into bigger ones. Firms can create speed and scale by automating the repeatable steps and surfacing exceptions early, so they are cleared before they become fires. Here, in this instance, the fractional workflow or obviously can act as a pressure valve, where they can help you design handoffs, script a recurring step, or set up a simple monitor while the core team stays on the market clock. As things become more automated, the day-to-day starts to feel less stressful. There are fewer manual handoffs, shorter cycles, and no end-of-day rebuilds. The third area, which I mentioned, is related to talent gaps. And what happens here is you'll have instances where portfolio managers or the research teams in these smaller firms, they have to get more involved in operational issues. Or you might have an instance where knowledge is concentrated in a single person. And, depending on who's answering questions for diligence, you might provide different answers. Firms can fix this really by creating clear ownership, have a name backup for each critical control, and a small ops utility team to take non-core work off the desk. As the volume of work spikes or specialist staff is needed, firms can add fractional or outsourced support to stabilize the function. They can help clean up the process, standardize reporting, or carry a work stream, while the firm keeps the decision rights. The result is more front office time on markets and responses that are consistent and not personal. So the bottom line here with all these things, the key is to align the data so every view matches, take the drag out of repeat work, and flex capacity for spikes. Policy and judgment should always stay inside the firm.
Eric, I'm gonna hop in there and jump back to data fragmentation. I think this is a huge challenge for growing managers. And firms as they scale, they often adopt multiple systems out of necessity, each solving for a specific operational need, while they attempt to keep their overhead low. This can result in a fragmented infrastructure, especially for multi-strategy managers or those working with highly specialized third parties. Even when outsourcing, managers may utilize 2 to 5 systems, each handling a different component of the reporting. And I think you said it, bells should be going off. This introduces risk. It limits scalability by creating manual handoffs, those reconciliation challenges you were talking about, and potentially rekeying data just to produce one set of statements or financials. Sometimes using multiple systems is a necessity to achieve best-in-class support, but having time to evaluate and integrate them isn't within your capacity or your skill set. So it further exposes those talent gaps you mentioned. I think both of our firms do a great job of constantly reevaluating systems against best-in-class functionality. And we invest in building infrastructures to connect these platforms, even when they don't integrate directly out of the box, right? You're setting up systems that communicate in real time, allowing managers to view performance broken down by individual loans or positions, and exposing this information to investors, allowing them to see detail instead of a single markup or markdown, right? It's not just about having the right tools, it's about making them work together seamlessly and having an expert team in place to execute with them. That's how you scale with confidence and maintain control and deliver the kind of investor experience that sets you apart from the competition.
Yeah, absolutely.
Thanks, Tyler. Okay, so Eric, you've given us your perspective sitting in the hot seat in-house at the manager side. Tyler, you've given us your perspective as a partner, guiding clients through this process, advising on best practice and giving them that confidence, as you mentioned, to scale and set themselves apart. Kurt, when we were preparing for this panel, you mentioned 3 critical phases during the transformation process. So I'd like to ask you, can you take us through these three critical phases, please?
Sure. Eric did a great job outlining where managers are struggling, like data fragmentation, process talent gaps. So the leading managers are solving for these through effectively phased transformations, generally 3 phases: diagnostic clarity, targeted execution, and then finally institutionalization. So starting diagnostic clarity, this is the relatively easy part in terms of pinpointing where operational risks exist, focusing on 2 primary issues: those that create allocated risk, and of course scalability limits. However, finding the right balance between over-engineering and under-preparing is significantly more challenging. This is actually where an Aruta best practice review could be helpful. In terms of phase 2, targeted execution, if you have the resources in place to effectively address them, obviously great. If it's premature to have added overhead or to add overhead, then deploy fractional experts, CFOs, COOs, CTOs with very defined mandates. So their job isn't to stay forever, it's to architect scalability, and then most importantly, you got to transfer that playbook. In terms of institutionalization, clearly you want to keep policy and oversight internal. You've heard that, and you will continue to hear that. But leverage trusted partners like Aruta, Waystone for execution, compliance, reporting. So for those managers that don't already have it, finding that balance, internal control with external scale, that's what converts operational fixes into actual institutional credibility. So the takeaway, I hope the takeaway is the transformation or this type of transformation, it's not binary. And once those phases stabilize, you'll be able to feel it, right? The day-to-day rhythm changes, calmer weeks, faster turns, better meetings. Yeah, lots of good stuff coming from, getting your act together.
All right, so just to summarize, 3 core and critical phases. You've got phase 1, diagnostic clarity, phase 2, targeted execution, and phase 3, then your institutionalization of that process. So 3 good takeaways to leave with our audience today. Eric, I think you've seen operational compounding firsthand. I'd love to get your perspective if you've anything to add to that, please.
Yeah, I know I definitely have seen that. I mean, I think if we take the phase plan that Kurt just described and look at the impact on the weekly cadence within the firm, you really will see the impacts right away. Weeks are less chaotic, owners are clear, handoffs are simple, and small issues don't really linger. So, and if they're in ODD, audit, and investor meetings, leaders can answer on the spot from the same view that the rest of the firm uses and explain how the figures were derived. And also because the phases are transparent, with the name owners, the quick check-ins, the simple timelines, people are actually using the process rather than trying to work around it, which is often an issue at firms. Issues go to the right place, they close faster, and they stay closed. In addition, really on a day-to-day basis, the DDQs pull from the system and updates land on time. So no one person, becomes the bottleneck with these things. What investors tend to notice is the stability and efficiency, and that the team spends less time explaining and more time deciding. Over time, because of all these phases, capacity will start to show up. More accounts and more requests on the same head count and at a steady pace, and audits and ODDs start to feel routine.
Yeah, I agree. Capacity is the main driver, right? One of the first questions that we're met with is, if we partner with one of your firms, how quickly can we see results? I think the answer is faster than you might expect. Within just 90 days, we typically see meaningful improvements in operational efficiency, and that's driven by a daily processing model, integrated systems, and that dedicated support team that both of our firms offer. They immediately start addressing your pain points. You see faster NAVs, cleaner reporting, better alignment with investor expectations, right? We're by the 6-month mark, most managers have undergone a full operational transformation with automation, integration, scalability, all at the core. And because both our firms, Waystone and Aruta, offer modular support networks, you can essentially drag and drop services into your operational model as needed, right? All this happens without pulling focus from deal flow or cap sourcing. In fact, managers are able to see a reduction in operational costs of up to 30% while gaining the infrastructure needed to scale with confidence.
Thanks, Tyler. So the pathway that you've all identified here is that each quick win can build to significant transformation. Next, I'd like to segue to explore how this can scale across different fund sizes. So what we're seeing is that whether you're early stage or you have already scaled, the pressures of life cycle needs, allocator expectations, and compliance demands are really leading managers towards choosing both fractional leadership and outsourcing as smart and flexible solutions. Kurt, given your experience, I'm going to move to you first for this one. And I would like to ask you, how does operational strategy differ between your $50 million emerging manager and then a $5 billion scaled platform?
Okay, I mean, forgive this, but first I'll start with a very obvious statement. Operational strategy, it has to evolve with your fund's life cycle, right? What builds credibility at 50 million can certainly be a drag at 5 billion. So for emerging managers, the goal is absolutely credibility through infrastructure, right? The allocators are buying confidence, not just returns. So early partnership with a fractional COO or CFO leadership and Waystone for administration signals institutional rigor from day one. And then as you scale, your focus shifts toward consistency and control. So allocators start testing your ability to manage complexity. So you may have multiple funds, different asset classes, operate in different jurisdictions. They're looking to see if there are any cracks in your operations. So instead of rebuilding systems, funds should be trying to integrate scalable platforms and specialized expertise that grow with you. So at the institutional level, operations become a lever for performance and margin. I mean, obviously, you're always concerned about performance and margin, but at this point, you have sort of made your operations as efficient as possible. Or technology, automation, data intelligence, all that type of efficiency is what turns into operating alpha. So the unifying principle is pretty simple, right? Evolve before the allocators make you, right? Plan ahead rather than play catch up, and then build each stage to anticipate the next. So it's pretty simple, but again, it's the issue is execution, right? This is how firms become credible at 50 and stay competitive while scaling well into the billions.
Thank you, Kurt. Eric, I'd love to get your perspective on this.
Yeah, sure. And I'm with Kurt on this. I mean, different stages require different jobs. You can't go from Excel to enterprise overnight, and you really have to scale in sequence. So, early on, the goal really is about building credibility. At a minimum, firms should have processes in place so that everyone knows the cash, the positions, the playbook, and that all this information matches across systems. As firms grow, it's the volume of things, not necessarily the complexity, that does most of the damage. So there are more files, more touch points, and small breaks that can age into bigger ones. So the answer here is actually fairly straightforward and simple than it sounds. The key is centralized data to feed trading, risk, and reporting from the same source, and so that the numbers agree. And also you make sure you surface issues early so they're fixed before they become fire drills. In practice, I feel like growth feels more chaos as there are numerous asks landing at once, more investor updates, more new accounts, new products, while the internal teams need to continue to manage their BAU. The firms that do this well, though, don't just push harder, they make the path smoother, with fewer manual handoffs, clear owners, and work that moves through the clear developed processes. As firms start to feel more institutional, the temptation is often to over-engineer and add more processes, but they really should try to resist that. To keep the judgment inside and add outside hands only when the volume spikes. What investors notice isn't necessarily the systems and tools that have been put in place, it's the output from them. Shorter cycles, fewer end-of-day rebuilds, and answers that line up across teams. They see a shop that can take on more without breaking the system. So really across every stage, the needs are more or less the same. One shared place for data, simple processes repeated well, and a weekly routine that keeps drift from sneaking back.
All right, thanks, Eric. I'm going to pick up on one thing you said there that I really loved. surface issues early so that they're fixed before they come meetings. I think that's something everyone could take away industry-wide. Tyler, I'm going to switch gears to you now and ask, how do you help your managers move through these gears, right, without losing momentum?
Sure, and I think, both my co-panelists here have said it. No two managers are the same, and neither are their operational needs. And so that's why our firms have built modular service models designed to scale with you. Whether you're launching your first US fund or you're managing a complex multi-jurisdictional platform in Asia or the Middle East, our solutions both act as building blocks. Start with the essentials, say fund admin and compliance, then expand as the operational infrastructure of your business evolves. Do you need regulatory support? We've got that. Are you looking to raise capital in new markets or navigate cross-border requirements? That's where our distribution support comes in. And because we're a trusted name recognized by investors globally, that alignment gives you credibility from day one. As we have all said, our goal is to be more than a service provider. We aim to be a strategic partner, an extension of your own team, offering that seamless real-time data access, unified frameworks, and expert-level support every step of the way. You're not just outsourcing tasks, you're building that foundation for long-term success.
Yeah, I'm just to jump in. I mean, I think that building block model, that really is exactly how I would stage upgrades in practice. Add what you need when you need it and keep everything attaching to the same core. So you're not building things bespoke and then you could outgrow, 6 months later. We really need to focus on the data, the basics first. So make sure you have a clean close, cash controls, pricing processes. From there, we formalize oversight and reporting. Only really after those basics are running steadily do we add dashboards and analytics. That way, the sequence is staying modular and we don't pull teams off the desk. So in terms of timing, I tend to watch for 3 simple triggers. This one, like exception rates are creeping up, 2, cycle times are getting longer, or 3, new key person choke points, tend to present themselves. So the key is not to wait for crisis and to keep the responses straightforward and transparent. So when you do this, lock the scope early and be clear on what will get done and what won't get done. Define pass-fail criteria for a short parallel run before go live, and plan a timed cutover with a tested rollback, and run a brief hypercare window with real-time support for issues. You must be clear with all those impacted about what things change, which don't, and who to call when there are issues. Make sure you keep policy, golden data, and oversight inside the firm. But in that said, bring in specialists for the surges and keep the internal team focused on investors. You could measure the success of this really by improvement in your KPIs. Open issues resolved, resolution times are being kept under targets, and deliverables are landing on time. Once everything starts to feel routine, that's when you can hand it back to BAU.
All right, thanks, Eric. And Kurt, I know at Aruta you spend quite a lot of time thinking about this and thinking about how you can help your managers to anticipate rather than react. If you wouldn't mind giving us 2 minutes on that sense of anticipation, I think that would be a great compliment to round out this section.
Sure. The anticipating is obviously very, very key. So anticipating operational needs, you have to start with structured lifecycle planning. It's the framework that Aruta applies across all of our advisory engagements. You have to think in 3 dimensions: capital, complexity, regulatory, right? So where's AUM likely to be in 3 years and how fast are you going to get there? What are the new strategies or markets that could add friction? From a regulatory standpoint, which jurisdictions or standards are going to require new oversight? So once you've had a chance to forecast this trajectory, obviously you're going to identify the capability gaps before they become constraints. That's again the most important, right? Early. So this is the window to bring in fractional executives. They build frameworks, execute projects, and most importantly, transfer playbooks, and all of this without having to commit to overhead prematurely. So this modular approach that Tyler continues to refer to, it actually creates something that I call operational optionality We've talked about operational alpha, but let me sort of introduce the term operational optionality. So this is the flexibility to scale when an opportunity first appears instead of having to scramble when growth actually arrives, right? So it's easy to think about operational optionality as powering the engine, and operational alpha is actually the output.
All right, I love that. So Kirk, to paraphrase you here, anticipation over reaction is the most powerful framework that you can employ here. All right, so let's take this conversation to the next level then and discuss some real world examples. And we're going to talk about some case studies here that we have seen, and then analyze those. I'm going to start with one. So I'm going to give you a recent example that we had at Waystone. We had a client who is a $60 billion US asset manager, traditional asset manager with funds across multiple domiciles. They decided to set up a PE and VC arm in the firm. So very new to the firm. They had used one of the large custodian banks for their traditional business, which included 40 Act funds and UCITS in Europe. And they decided to administer their private markets funds in-house. So due to the nature of their VC funds in particular, they ended up having in excess of 350 unique investors. They needed to outsource investor AML and KYC and ongoing screening because quite simply they didn't have the resources internally to help scale at the level they wanted to. There were three main reasons that drove them to outsource investor AML and KYC to Waystone. So I'm going to take you through those three reasons. Number one, they had Cayman funds. The Cayman funds have an MLRO. That MLRO needed to see adequate procedures around AML collection. And normally this is delegated to a third party, right? So you have a fund admin in a lot of instances. And here the manager was still administering their funds in-house and they were struggling to compete this manually due to the increase in volume of investors. Number two, quite simply put, they didn't have adequate internal resources or technology to do this daily screening. They couldn't sanction screen appropriately and then conduct the ongoing monitoring that was required. And number three, looking ahead into the future, they will be in scope of FinCEN's AML rule when that's finally implemented. We thought that was going to be implemented sooner, and so they were planning ahead really to have a more robust AML procedure in anticipation of that rule. So really three drivers, all complementary. When they turned to Waystone, we could provide a solution that helped to mitigate the risk, to free up resources within the manager, and then as well, provide them access to a team that has the in-depth expertise, right? Insights into AML registry expectations, AML best practice, and then back that up with market-leading technology. So that's just a snippet of what has led some of our clients to want to outsource components of their administration and KYC. Tyler, I'm going to ask you to share another transformation story. I think yours is going to have a slightly different flavor, but hopefully a good example for the audience.
Sure. I mean, I can go with the classic example, emerging manager fund administration. So we had a manager come to us, very strong strategy, and they had secured a major seed investor already. They were off to a great start, but internally it was a small team focused almost entirely on deals, not compliance, formation, or administration. They knew they needed to deliver institutional grade experience for this investor, but they weren't sure what questions might come up during onboarding, what type of reporting the investor would expect, or how to handle the AML for the type of entity the investor was committing through. Instead of going to market to hire 3 or 4 different specialists, they came to us. We were able to step in with the expertise they needed. We looked across the landscape of thousands of funds and tens of thousands of investors that we've worked with, and we helped them navigate onboarding AML and KYC, which built confidence and credibility with their investor from day one. We also designed bespoke reporting that let them present as a detail-oriented boutique manager without sacrificing institutional metrics like IRR, TVPI, or deviating from ILPA standards. There were no rigid templates. It was just a customized look and feel backed by, institutional grade infrastructure. As they scaled, they were able to launch multiple co-invests. Their operational complexity grew with more entities, more reporting, and more investor touch points. But they kept their internal headcount lean. It's only around 5 people. So what they did, they looked to us and they added compliance support. And they eventually launched 7 co-investment vehicles, all while staying focused on deal flow and investor relationships. Like, that's the power of partnering with firms like ours. We're not just an admin, we're a strategic partner helping managers operate with global standards and deliver a world-class investor experience. I think, Miriam, you said it best, is, free up the internal resources by handling the, details behind the scenes.
Just that, I mean, what jumps out to me in both of these situations is that they more or less solve the same problem from, two different angles. So like in the private equity example, the complexity showed up early, right? It was one fund with multiple co-invest entities and LPs who expected tailored communications. That could have forced them into a lot of internal rebuild, but instead they set up an institutional core on day one by partnering with you guys for fund accounting, AML, KYC, investor services, and reporting, while keeping it flexible enough to produce, custom notices and disclosures. That's how you protect the firm's voice without losing control or adding headcount. In the other example with the, traditional fund, the constraint was a little bit different. It was a very strong investor, but with a very small team. So there the win wasn't more technology, it was creating credibility fast. A clean onboarding, KYC done right, reports that match what the anchor investor is used to seeing, and no one being forced onto a process that doesn't fit. That let the manager stay focused on their deals. So the pattern really is the same in both cases. Build credibility first, then scale. Create one set of controls, reuse it as entities grow or co-invests get added, and keep buying capacity only when the volume of work spikes. That's how firms stay lean while their platforms get bigger.
Yeah, actually, I was debating whether I would chime in here or not, but yeah, I think it makes sense for me to do that. So, I mean, what Tyler and Eric just described are the visible results of a deeper strategy, right? It's stage appropriate interventions that are going to compound into increasing operational alpha. So when I think about these 2 case studies, the simplest thing I pull away from that is, you crawl first, then you walk, and then eventually you run. Of course, doing it with intention. So crawling, to me would be akin to sort of you're building the credibility through institutional processes, even at a small scale. Right? You graduate to walking, you're layering in specialized capabilities, using fractional expertise and strategic partners. And then finally, when you are able to and do run, you're converting operational mastery is the word I would call it, into true operating alpha, right? So where excellence drives the allocator confidence, and most importantly, it accelerates capital formation. So this is the rhythm that Aruta helps managers build as their funds mature, aligning infrastructure, governance, and leadership.
All right. Thank you all for your inputs there. Hopefully some valuable case studies and insights. There are thousands more that we could reference, and we hope that those both would resonate with the majority of the audience today. And speaking of which, then I'd love to wrap up this session closing with some actionable insights, right? So I'd like to ask each of you to give us one key action for our audience, something that they can take with them, they can implement from the get-go. Eric, I'm going to start with you on this one, please.
Yeah, sure. I mean, so I guess, the path forward doesn't start with a big infrastructure rebuild. It really starts with building momentum. So, pick one place in the operational framework where work drags. Centralize data and automate where you can. Outsource the repeatable work, but make sure it's done with clear service levels and retrievable targets. Then, reuse and scale. Apply the same process to the next project and build credibility with each step. So in the end, what investors notice aren't the systems and processes specifically, it's the observable efficiencies created. Fewer detours, faster answers, and the team spending time on judgment rather than rework. That a compounding effect is the operational alpha, a repeatable operating edge, steady weeks, fewer file drills, faster yeses, and room to scale.
I'll jump in. I would say assess your current partners. Are they vendors or are they allies? Vendors simply take directions. Allies actively contribute to your growth. The right partner should do more than follow your instructions. They should embed themselves inside your operations, advise and anticipate your needs. They should bring insights from around the industry to help keep you ahead of the curve. Both of our firms believe strong strategic outsourcing and fractional support today isn't about handing off the work. It's about gaining access to institutional grade infrastructures, expertise, and technology without the burden of building it all internally. Managers are able to stay lean and focused while our dedicated support networks, who are invested in your success, handle the complexity that helps you scale effortlessly.
Thanks, Tyler and Eric. So my closing thought is think life cycle, act strategically. I tried to come up with something more elegant than that, but that's what I came up with. But in terms of what that looks like is basically, well, I'm a big believer in you get the right answer when you ask the right question. So the idea of think life cycle, act strategically boils down to, I think, asking yourself 3 questions, right? Where are we today operationally? Where must we be in 3 years? And what are the bridges that we have to start building now, right? So those bridges come from the right mix. So finding the right mix of, again, we talked about this before, you got to keep oversight internal, right? And maintain control and accountability, but sort of at the right time, in the right circumstances, utilizing fractional expertise to architect change. Think Aruta. Outsourced administration for scalable infrastructure. Think Waystone. So the firms that are going to win the next decade won't just be better investors. They will have figured out how to turn infrastructure from cost into advantage. So ultimately, operational alpha isn't accidental. Hopefully that has come through loud and clear. It's designed, it's deliberate. And as I think Eric had mentioned before, the best of all, it's compounding. So it's this is something that you want to get right. This is something you need to get right.
Couldn't agree more, Kurt. Thank you so much to all 3 of you for some outstanding insights. I think the message is clear that we want to leave with the audience today. Operational alpha is not accidental. It's very deliberately engineered. Through strategic partnerships, targeted expertise, and scalable infrastructure, firms can transform their operations from a necessity into a clear advantage. So to recap today, we've explored how funds right across the spectrum, from $50 million emerging managers to multi-billion-dollar platforms, are using fractional expertise and strategic outsourcing to transform infrastructure from that compliance necessity into a clear competitive advantage. Firms are having to stay agile. They're trying to meet and exceed institutional standards and keep up with regulatory complexity. We are available after this session for any Q&A. We'll leave our details at the end of this. I'd like to thank each of you, Eric, Kurt, and Tyler, for your insights today and for your participation. And thank you all for joining us. Until the next time.
Thank you.
Thanks.